Right, so today we're going to talk about economic statement conversion. Basically, what we're going to do for valuation is we're going to eventually use the Modigliani-Miller format for enterprise DCF valuation. Okay, so what that basically means is a company is worth the sum of its future cash flows. And what we're going to do is we're going to break those cash flows into two categories or buckets. One bucket is called operating cash flows, which are the primary cash flows associated with your business selling its products and services. And the other bucket or category is going to be called non-operating cash flows, which are cash flows the company generates which has nothing to do with selling products or services to customers, but still have value to the business. Right? Those two buckets are added up to be called something called enterprise value. Right? That's the model on the right. And it is that enterprise value that can be distributed to the debt and the equity holders. Since the debt holders are paid first, we pay them off, and then residual goes to the shareholders, so whatever's left belongs to shareholders. Matter of fact, if you take that equity value, divide by shares outstanding, you get share price. That is enterprise DCF valuation. Right? So the hard part of all of this is that the model is easy, but creating the statements in this format is what's going to be hard because the accountants don't do us any favors. Right? So a lot of what we're going to talk about today is how do we take FASB, IFRS, GAAP accounting statements, right, and basically turn them into a Modigliani-Miller format. Right? There's an advantage to doing this in that it will make the analysis and valuation easier, but nonetheless, it's an extra step in the valuation model that we will need to do. Right? To help you with this process, I am going to use a mnemonic. Okay? The mnemonic is only going to be used in this class, so if you start talking about the 1, 2, 3s, and 4s anywhere else, people are going to look at you like you're cuckoo for Cocoa Puffs. Right? And so the mnemonic that I'm going to use is that operating cash flows are going to be called ones. Non-operating cash flows are going to be called twos. Debt, which is interest-bearing debt cash flows, are going to be called threes. And equity cash flows are going to be called fours. All right? So if you think about this model over here on the right, 1 plus 2 is enterprise value, which equals 3 plus 4. Okay, just kind of putting numbers by these. Matter of fact, 1 plus 2 minus 3 equals 4. Okay, just a simple way of expressing the lots of words down to a concise series of buckets. All right, but labeling the buckets you're going to find will be very helpful. So to help better understand the process we're about to go through, I think a picture is worth 1,000 words. So the picture of the process at a high level is on the next slide. And what we're doing is a 3-step process. Traditionally, when you're taught valuation, you're taught a 2-step process, which means you go straight from financial statements directly to valuing cash flows. We're going to have an intermediate step, and the step is highlighted on this page. So the first thing we're going to do is we're going to start over here, statements works left to right, with the accounting statements, which are the income statement and the balance sheet. Okay, so you just go find the company's income statement or the balance sheet. That's the first thing you need. Then we're going to rearrange and convert and map these statements into a Modigliani-Miller format. So this is the extra step that we're going to take in this class that you don't normally do. Okay, and so essentially we're going to take these statements and map it to this 4-box model. Okay. Now, it doesn't matter which statement you do first. You do the income statement or the balance sheet first. You're going to have to eventually map and rearrange both statements. And the metaphor that I like to use is that if you ever, as a kid, had a Lego toy and you ripped it apart and you put it back together as something else, when the statements are rearranged, there can't be any Lego blocks on the floor. So every single item on the statement has to be accounted for when we rearrange these statements. Can't leave any Legos on the floor. And most importantly, we have to end with balancing statements in the rearranged format, just as we started with balancing statements in the original income statement format and balance sheet format. So we have to balance what we do. It's just very important that we account for everything, can't miss anything, and when we put it back together, it balances. In this class, an unbalanced statement is an incorrect answer. You will not get credit. You will not get partial credit for an unbalanced statement. Okay, be very, very clear about that. So what do I mean by balanced statement? So we'll start with the income statement. We're going to take the income statement and we're going to first label it. And we're going to say, okay, find everything on the income statement that is operating, that helps us drive operating cash flows, that has to do with selling the products and services. And we put that together. That in the rearranged statement for income is going to be called NOPLAT or NOPAT. Net operating profit after tax, net operating profit less applicable taxes. We're going to take everything off the income statement that is non-operating, and we're going to put it on the rearranged statement, and we're going to call it the non-operating income. Operating profit, NOPLAT, plus non-operating income is going to equal something called TII, total income available to investors, which is the Modigliani-Miller formatted statement name. It's McKinsey's name for the statement. What we're then going to do is we're going to go back to this income statement. It's got a balance. And we're going to say that equals to all of the debt payments, the interest-bearing debt payments off the income statement, interest expense, and put that over here on the debt side. And all of the amount that belongs to the equity holders, the net income. This is the amount of the income that belongs to the shareholders. The debt plus the equity payments off the income statement equals the TII. So both sides of the TII will balance. Operating profit plus non-operating profit is income, which is the income that can be distributed to the debt and the equity holders. Both sides of that statement will balance. We're going to follow the same process with the balance sheet. So we're going to take the balance sheet, and again, we're going to break it up into 4 pieces. The first bucket, the ones, is the operating bucket. All the operating assets, net of the operating liabilities. That is called operating invested capital, or invested capital for short. But I want to put an asterisk by the word invested capital, because in this class, when we use the word invested capital, we're using operating invested capital. That's what we are referring to. That is different than what people call invested capital outside of this class in the real world and in other academic classes. And I'll tell you why it's different in just a second. We're then going to take off the balance sheet all of the non-operating assets and liabilities. And we're going to take the non-operating assets and liabilities and net them together. And that's going to get us our non-operating capital. Our operating invested capital plus the non-operating capital is going to sum to something called TFI, total funds invested. By the way, TFI is what the rest of the world calls invested capital. And I'm going to give you a more formalized definition of invested capital, the operating invested capital, than the shortcuts that are taken in other classes. The third thing we're going to do at the balance sheet is we're going to look at all of the debt. All the interest-bearing debt is then going to be put into the third bucket, the debt capital. And all of the equity accounts off the balance sheet are going to be put into the equity capital. Therefore, operating capital plus non-operating capital is TFI, which is long-term financed by interest-bearing debt plus equity. That's going to be the definition that we're going to use for TFI. Okay? So, it doesn't matter whether you did the income statement or the balance sheet first. But you would have had to do those 2 statements and convert them to get to statement number 3, which is the CFI or cash flow statement. Yes?
So I have a quick question.
Mm-hmm.
In the statement, so we took the non-operating profit after tax, right? But we didn't apply tax to the non-operating.
Oh, when we actually do the conversion, we're going to split up the tax to affect each of the areas.
Okay.
So the taxes will be looked at based on the area that it actually impacts. So yes, we will split up taxes. All right, good question. If you have other questions, please ask as we go along. Yes, sir.
What will be our final reference in terms forecasting? Just because you said like accountants might go operating.
Well, that's the part. The hard part is one of our subjective parts of our process is interpreting a balance sheet item as operating, non-operating, or debt or equity without any help from the accountants. So in the real world, it's a little bit of subjectivity. Like the ideal world, like when I do this, I'm privileged sometimes to work with a CFO or a controller, and I'll just straight up ask them. I'm like, all right, what's in this other asset category? Because I don't know what it is. And there's like, it's like a mismatch. And so then they'll kind of say, well, it's these types of things. I'll say, okay, well, those are the things you need to sell products and services. Yes, operating. Those are the things you don't need, non-operating. In an ideal world, do you have a breakdown of other assets so we can put them in both buckets? Like that's ideal. But we're not going to always have ideals, so we're going to have to make some judgment calls. But that's something which we're going to get into. A lot of it will be after the midterm, by the way. Okay, we're going to start easy, but the training wheels are going to come off because accountants do everything they can to make our lives miserable. All right, so CFI. CFI is cash flow. To get cash flow, income statement minus change in balance sheet is cash flow. So to get the CFI, we're going to do that process 4 times. Always 4 times. To get free cash flow, which is the operating cash flow of the firm, we're going to take the operating cash flow for the income statement, the NOPLAT, minus the change in the operating invested capital of the balance sheet, and that's going to get us our operating free cash flow. Or we'll simply call it free cash flow and assume it's operating. We're then going to take the non-operating profit from the income statement, minus the change in the non-operating investments in the balance sheet, non-operating cash flow. Operating cash flow plus non-operating cash flow, CFI, cash flow available to investors. And it is that cash flow that can be distributed. Well, the first one's to the debt holders. How do we get that? We can work across or work down. The income statement cash flow to the debt holders, the interest payments, minus the change in debt in the balance sheet, cash flow to the debt holders. Off the income off of the income statement, which is actually the dividend distribution, cash that's actually paid to the shareholders, minus change in equity, cash flow to the shareholders. Debt and equity cash flows, cash flow available to investors. So the statement's format, and this is important, it's not FASB. This is not IFRS rules. It's Modigliani-Miller. It's actually set up to say, I have cash on one side of the statement, the top half. What did I do with the cash? I distribute it on the bottom half of the statement. The two sides must balance. Okay, saw a hand in the back?
Yeah, I'm just confused. Can't we just look at the cash flow statement to find the things on the far right?
You could if the cash flow statement were in this format, but the GAAP statement of cash flow is not this statement of cash flow. Because the problem with the FASB GAAP statement of cash flow that you see in a 10K or a 10Q is it's made to reconcile the change in the cash balance. That's what the cash flow statement that the accountants give us. Our cash flow statement is about how much cash the business is generating that can be distributed to the investors. We're not reconciling a cash change. We're reconciling how much cash is generated and paid out. It's a different theology to the actual statement, right? Because here's the point. Once we know the cash flows, our final step will go to the last column, which is we'll forecast the cash flows. When we forecast the free cash flows, we get the operating value of the firm. That's box 1. We forecast the non-operating cash flows, we get the non-operating value of the firm. You add the two together, you get the enterprise value of the firm. Okay? By the way, pay off the debt, you get the equity value. I can also forecast the debt that I have to pay off by forecasting the payments to the debt off the income statement and the balance sheet. Or I could do as residual of how much debt I have from my enterprise value. I can work across, I can work down. Right? Advantage of putting in this format, it also helps us with analytics. What's operating ROIC? NOPLAT divided by invested capital. We got a clean operating ROIC. And, by the way, this also highlights the differences between the real world ROIC and the ROIC that you're going to learn in this class. Right? And here's what you're going to learn here that you won't learn anywhere else. Is that when I showed you in our last class, on the video, you can go back and look at this, I said the operating ROIC is different for example, tech companies. Google or Apple's ROIC is much higher than Bloomberg's ROIC. What Bloomberg does is they take TII divided by TFI to get CFI. This is how they get ROIC. This is what's taught in the rest of the world. What the rest of the world is doing is total income available to investors divided by total funds invested. Because what they're not doing is they're not bucketing out the operating ROIC and the non-operating ROIC. They're leaving them combined. And that's what TII is and TFI is. Yes?
So I understand like the way we're going to learn ROIC is like the more effective way, but like
Yeah.
the rest of Wall Street's doing this one way. Like,
It's not the rest of Wall Street. What I'm telling you is when we do our valuations, you're going to find we're still getting the same values, but your model will be much more easy to understand how you got to the value than the compromises they actually had to make on Wall Street. Because here's the thing. The real challenge with why it's a real problem is because when you forecast this column, you're assuming that these two stay the same. It's the same reason why McKinsey's key value driver formula is an improvement on the growing perpetuity. Because if I use a growing perpetuity, cash flow divided by R minus G, I can't change the IRR. I can't change the ROIC. I have to use whatever it is today implicit in the formula. In the rearranged cash key value driver, no plat times 1 minus G over ROIC divided by WACC minus G, which is the same formula, just rearranged, I can have an explicit ROIC. So therefore, I can have one in the future that's different. It's a slight improvement. Same idea here. In the traditional formulas that you're taught in other valuation classes that people use in the real world, they're not breaking out the non-operating cash flows. They're just leaving them bundled, and they're assuming they're growing at the same rate because they're assuming they don't exist. Now, again, I'll give you my legacy view on this. I went to Wharton in the 80s. I'm old, right? Didn't used to feel old, but you guys make me feel old, right? And so here's the point. My professor in finance, when I was on your side of the table, came from Chicago. They were the original people that wrote all the textbooks. They invented modern corporate finance. And I like to say it was a simpler time because back in the 80s, non-operating assets hardly existed. They didn't have joint ventures. They didn't have global supply chains. They didn't have hundreds of billions of dollars of excess cash sitting overseas for tax advantage reasons. None of this crap existed. They didn't have off-balance sheet leases at the scale that we have operating leases today. It just didn't exist. Those markets didn't exist. So when they put these formulas together back in the 80s, and Bloomberg actually built these formulas in the 80s with Wall Street all combining to say, let's agree on everything, the non-operating investments were trivial. So what they did is they said, we don't have to worry about them. So it wasn't that it's unacademically valid. It's just they didn't really exist, so nobody cared. And by the way, 30 years later, those formulas haven't changed. Those textbooks haven't changed. Look at Briley and Meyer, whatever edition they're on, 10th or 11th. It's the same formulas they were back when Briley and Myers was written back in the 80s. And so what I'm telling you is what we're doing now is we're just kind of going back to the academic side and recognizing that those deltas actually are significant enough that we can improve on some of the valuation technologies based on the shortcuts that we're taking. And so what you're going to learn in this class, more than anything else, is when a shortcut was taken. Right? And I'll give you an example, a clear example if you want to see a shortcut, which is, look at this. This is the balance sheet. Debt plus equity, okay, equals operating and non-operating. In fact, you can see it on the next page. Assets equals liabilities and equity. In the traditional ROIC that you'll find in Bloomberg, interest-bearing debt plus equity is assets minus non-interest-bearing liabilities. Okay, so interest-bearing debt and equity is what they call invested capital. But it's all of the assets, operating and non-operating combined, minus the non-interest-bearing liabilities. Our approach is this. Take the assets, split them in two, operating and non-operating, recategorize. Take the liabilities, non-operating and operating. Operating invested capital, non-operating capital. Put them into two blocks. They're both debt and equity, right? And this is why it matters. Go back to the real world. I think I'm still logged in. No Microsoft. Now's not a good time. But if you go back to Bloomberg, oh God, I just said no. Love Microsoft. All right. So if you go back to Bloomberg and you look at their definition of total invested capital, straight Bloomberg field, and you right click on it and you show the definition, their definition, debt plus equity, plus other equity-based accounts, basically. Debt plus equity. That's all it is. That's invested capital. Matter of fact, go look up the definition of NOPLAT. It's basically net income, adding back some items, but they don't add back all the non-operating items. They don't back all the interest expense. So that's what I said. This is what I would call TII and TFI. They're not splitting this out. Why does this matter? Well, this matters because, as I showed you last week, if I'm doing Google, there's a big difference between Bloomberg's definition of ROIC, which splits them together, keeps them together, and our definition, which takes operating out. See, if I went with the railroads, I'll go back to Union Pacific, there was almost no difference between the two. The operating and non-operating are almost the same because railroads don't have a lot of non-operating assets. So that's what I'm saying. Back in the 80s, companies looked more like railroads. They had PP&E, they had inventory, they had receivables, they had payables, a little bit of cash. That was their balance sheets. They didn't have anything else in their balance sheets. So when these formulas were created, nobody worried about the non-operating assets. You have $100 billion of cash sitting off in Ireland. You have all these off-balance sheet liability financing. You didn't have stakes in other companies which were worth hundreds of billions of dollars. Like, basically, what's the latest company? The company who owns a big chunk of WeWork?
Oh, the week company.
SoftBank. SoftBank. You have companies like SoftBank, which have passive investments in all of these companies all around the world, and their value hasn't to do with running the business. It's investing in other businesses. All that stuff is a relatively new phenomenon in the last 30 years. And so it just makes the traditional valuation harder to do. So it's ironic that we really have to go back to the original formulas to help us understand. So what you're going to get out of this class, more than anything else, beyond a cleaner way of doing it, is you're actually going to get two benefits. One you're going to hate, one's going to help you. The one's going to help you is when other people take shortcuts, you're going to know they're taking a shortcut. And I don't want you to ever go to somebody and say you're wrong, because they're not wrong. It's just they're taking a shortcut. It's okay to take shortcuts. I'll take some shortcuts. But at least I need to know what shortcuts I'm taking, because there's limitations sometimes in shortcuts we take. The other thing you're going to do is you're going to balance things. In the real world, people don't balance things. What I mean by that, I'll go back to cash flow. In the real world, they'll stop at forecasting free cash flow. They don't go through the rest of the statement and see where all the money went and balance what was generated and what was spent. Which means if you make a mistake, you have no idea. If I forget in the real world to leave something out of my free cash flow calculation and I don't balance it, how do I know that I made an error? And the answer is I never do. So this is the part you're going to hate about the class, which is I'm going to force you to balance your statements because it actually reduces your errors, right? And that's what's the standard I'm going to hold you to. And in the real world, people don't have that standard. But here's the consequence. In this class, you don't have an unbalanced statement, you lose 2% of your semester grade. In the real world, you don't have an unbalanced statement, they get fired. You're done. Your career's over. You walk into a CFO with a valuation model, and you forget to put something in free cash flow, your career is over. Right? Your firm's going to fire you because they're not going to fire the partner. They're going to fire the junior person. And then once you've been fired, and then word spreads about why you've been fired, good luck working anywhere besides an Amazon warehouse picking and selling packages. You're done. So the advantage of this approach is it's actually career preserving. All right, being a little over dramatic. Maybe I'll get a job at like Macy's or something. I don't know. Where do the English majors go? All right. So, sorry, I know that was sarcasm. That's not true. All right, back to this. I'm going to follow these simple statements, and we're just going to apply this process to the spreadsheet. So I uploaded to Elms a copy of a spreadsheet which shows this conversion so you can follow along. But I actually want to show you the examples from the book of how they do some simple conversions because this is the process you're going to use on your assignments and eventually your grades. All right, so let me start out with this simple statement that we want to convert. And in the book, they started out with a balance sheet. So this is the balance sheet. This is the simple income statement. right? So the first step in all this process is to label. As I said, this is a step that's unique to this class and Professor Perfetti's approach, but you'll find it will help you. So by labeling, what it means is we're going to go through each one of these items, and we're going to label them, 1, as operating, which means it has to do with selling products and services on a normal basis. 2, non-operating, has nothing to do with selling products or service. 3, debt cash flows, an interest-bearing debt payment that has to be repaid with interest. And 4, an equity cash flow, which is a cash flow that belongs to a shareholder. Cash, 1, 2, 3, or 4. Operating cash flow, non-operating cash flow. 1. Could also be a 2. Trick question. For this assignment, we're going to call it a 1, this example. But I'll tell you, after this simple example, starting with your next homework, it's going to be both a 1 and a 2. So this is an example of a difference with this class and why you can't use Investopedia. It will screw you up in this class, right? So here's my example. When I was 15 years old, I worked at the drive-thru at Burger King. It was one of my first jobs. And it wasn't very glamorous, but what I did is I'd leave school, go in, I'd meet with the manager in the office, and the manager would pull out of the safe a till to basically we count all the cash in the till, and it was either $80 or $120. I forgot exactly how much, but the same amount every time I started my shift. We'd count it out. I'd walk with in my hand to the register in the drive-thru. He'd turn a key on the old cash register, print out a piece of whatever the tape was, take out the till, put in my till, and then turn his key back, and I would start my shift. At the end of the shift, the process would repeat with somebody else. They'd turn the key, they'd take my tape and my till, and then we'd walk back to his office. We'd count the cash at the register. We'd leave the same amount that I started with, the $80 or $120, and then he took the rest out. Why did he leave, let's say it's $120. Why did he leave $120 in the till? Yeah.
That's how much you needed to run the business.
Exactly. That's how much you need to make change. You can't actually not make change if people come in, especially back then, which we didn't have as many credit cards payments as we did today. So that's what we're going to call operating cash. There's an amount of cash, and I learned this at 15 years old, didn't realize it, that a business cannot pay out. It's going to be used to make payroll. It's going to be used to run the business day to day. It's going to be used as working capital, and that's called operating cash. The rest of the cash that isn't used to run the business day to day is called excess cash, and that's the cash that can actually be distributed. And this is an example of a real-world shortcut. You were taught in a different class the concept of net debt. Debt minus cash. That's net debt, right? That is a fallacy. There is no way in any scenario that cash can be paid to the debt holders. Would never happen in the real world. Because if a company went bankrupt, the first thing would happen is the court would set aside some of that cash to go to the lawyers. Right? I'm part of the Equifax settlement, the theoretical $125, but the first $80 million is actually going to the lawyers, the class action lawyers. So even though Equifax is paying out some big amount of money, the real beneficiaries here are the lawyers. And then the employees are going to get paid their unpaid wages. The IRS is going to come in and take some of the taxes. I don't care how secured you are, you're never going to see all of that cash as the secured debt holder. So what I'm saying is you're going to get the debt minus the excess cash is your net debt, not all of the cash. I'm just saying it's a simplification that people have done in the real world, but it's a simplification. The reality is you'll never get that operating cash. So in our models, we're going to actually start, not in this assignment, starting with your first homework and then on the midterms, we're going to break out operating cash and non-operating cash. And it just means that operating cash is cash that can never be paid out. It's part of the operations. Excess cash is a 2. It's a non-operating cash flow, and it is cash that can be distributed to the value of the business. We're going to also start with a very simplified rule of thumb, 2% of sales. It's just a simplification. There's one I will use. 2% of sales is 1 week of cash. I'm going to say that 1 week of cash can't be paid out, 2% of sales. Now, some businesses, the number might be higher. And the way you actually find this out in the real world, talk to a treasurer. Talk to any treasurer for any big company. They know how much cash they need that they can't really pay out. And so it's easier to do this in the real world, but in our case, we're going to have to make some estimations. So one of the estimations will make us 2% of cash. The good news is between now and the midterm, You're not going to have to do that math. I'm just going to give you a statement to convert that'll say operating cash and excess cash. I'll already have it split out. Okay? Gets harder when we get past the midterm because we deal with real world balance sheets. God knows what the accounts are going to call it on the 10Q or the 10K. And then we got to figure out how much goes into each category. All right, that'll be the fun part. All right, we got to get started. Inventory. Operating, non-operating. Operating. Property, plant, and equipment. Operating, non-operating. Operating. We actually use the property plant to build the inventory to sell the products. Equity investments. I'm SoftBank. I own 20% of WeWork. Non-operating. Passive investment. Actually, I don't know how much SoftBank owns, but let's assume it's passive investment.
It's 30%.
30%? There you go. Okay. All right. Accounts payable. Operating liability, non-operating liability, interest-bearing debt. All right. Is accounts payable interest-bearing? We can eliminate the threes. It's not a three. So is it have to do with the course of running our business day to day with the suppliers, or is just other stuff we owe miscellaneous? It's operating. 1. The category sums we don't have to worry about. Interest-bearing debt. 3. By definition, a 3. Retained earnings. 4. That's the equity. Right? Very simple balance sheet we're starting with. All right. Next step, create a new tab. 1 tab per sheet. Label it TFI. Also, very important in this class, there's a solver floating around that students have created that auto solves converting these statements. I consider using a solver an honor code violation. You are not allowed to use solvers to solve for the conversion of these statements. You have to do it yourself, which also means you have to convert the statements in the spreadsheet I give you. If you submit another spreadsheet that is not the one that I gave you with the solution in it, at minimum you're going to get a 0 for the assignment, and likely I'll send you to the Honor Council with a recommendation for cheating. There is no reason to move outside the spreadsheet that I gave you to do these conversions for your homework assignments. By the way, these spreadsheets have digital fingerprints in them. So we also have some additional tracking on your homework assignment to make sure that it's really you doing it in these assignments. I hate to do this. It just has to do with people who've abused the system in the past. So I don't think you're going to do this, but I just want to let you know it's not a good idea to even think about going near that line. And it's also very important, you got to learn how to do this yourself. So 1 tab per statement. Start out with the TFI. Okay. I'm going to use relative references, so copy over the years, prior, current, and label. All right. Next, I'm going to put all of my operating assets and all of my operating liabilities together. I'm going to start netting them out. That's my ones. So go back, all of my operating assets, my ones, cash, inventory, PP&E. All my operating liabilities, accounts payable. You'll start to notice the groupings of the ones all kind of stay together. Tells you you're less likely to make a mistake. And then you net them to get something called operating invested capital. And so to get to operating invested capital, you take all of your assets and you subtract your liabilities that are ones. So 380, 440. All right? Now again, I might call this invested capital, but if I use the word invested capital, I'm talking about operating invested capital in this class. Right? Next, we're going to do the same thing with our twos. Anything that's an asset that's non-operating, that's a 2, equity investments, and anything that's a liability, that's a 2, we'd put on here. Now in this simple example, there are no liability 2s, But I will tell you on your assignment coming up, there will be liability twos that you'll have to net. And we net them just like we do the assets. And so we net them, we get our non-operating capital. So in this case, just the 50 and the 25. And if we add the two together, TFI equals the operating invested capital plus the non-operating capital, 395, 465. So this is the top half of the rearranged balance sheet. Okay, the operating and the non-operating capital rearranged. Now, following the Modigliani-Miller format, this will equal the long-term financing of the company. So now I'm going to go to the financing, or what's called the funds flow side of the statement, the debt and the equity. So this 395 and 465 will be financed by interest-bearing debt. So I look for all of my threes. I only have 1 3 on this simple statement. But this is another example of why you can't use Wikipedia. If you looked at Wikipedia, the definition of working capital is current assets minus current liabilities. Right? One of the current liabilities might be current portion of long-term debt. What would we label current portion of long-term debt in this class? 1, 2, or 3? It's 3 because it's interest-bearing. So even though it's a current liability, short-term debt or current portion of long-term debt would be put in the 3 category on this M&M statement. Okay, so that's what I'm saying. You can't just use traditional accounting to recreate these statements. It will confuse you. You have to kind of follow the logic and methodology we're using for these M&M statements. Finally, equity equals any of my 4s. The only 4 I have is retained earnings. Add up my 3s and 4s. 395, 465. TFI, TFI. This, by the way, is what I mean by a balancing statement. Yes, sir.
Can you give an example of what liability 2 would be? Like
Oh.
what a non-operating cash flow would be?
I'm taking a reserve because I have a liability for a guarantee to an executive for his vacation home. I don't think that's part of the course of doing business. Do you? I wouldn't call that operating. I don't need to do that to run my business day to day, but something I promised to do, so I got to put it somewhere in my balance sheet. So what I'm saying is companies will have non-operating assets. They'll have non-operating liabilities, right? And we'll have to start to distinguish them. Now, obviously, they could have something much more substantial, but that's the point. We got to figure out which one's which. If you want a more thorough definition, there's actually explained in our book chapter for the week. Okay. For purposes of this assignment, you don't have to worry about it. I'm going to give you the 1, 2, 3s, and 4s just to get you started. Right? But the question he asked is going to be a very valid one, because in about a month, we're going to be looking at statements from a 10Q or 10K, and we'll be like, what is this? Do we think this is operating? Do we think this is non-operating? Do we think this is debt? And you have to actually sometimes read through the footnotes to try and figure this stuff out. All right, this is what I mean by balancing statements. Here's one of the common errors that you'll make. I've left a Lego on the floor. I forgot to put accounts payable on here. Notice my TIIs don't balance. Even though one of these 2 TFIs is correct, for grading purposes, you're still getting a 0 on this tab. Okay? Because even though one of the 2 is correct, you're flipping a coin. There's only a 50% probability that you're guessing that one of the 2 is correct. Well, that's not a correct answer, right? So a correct answer, standard for this class, is that you must have not only the correct number, but simultaneously it has to foot. It has to balance. So this is what I mean by balanced statement. Every one of these statements will have 2 sides, and it has to have the same number. You will both appreciate this and hate this, because this will be your frustration in the assignment, which is, I can't balance a statement. This is where labeling will help you, right? Because labeling, as simple as it sounds, make sure that we put all the 1s together, all the 2s together, all the 3s and 4s, And very simplistically, count the ones. Oh, I had 4 ones here. Oh, I only have 3 ones on my statement. I probably forgot a 1. Right? It sounds simple, but this is the process that will help you when you have an unbalanced statement. Okay? So again, just trying to give you some tips and tricks to help you. Questions about TFI? Statement number 2, the rearranged income statement, TII. Total income available to investors. Equals. All right. So, same process. We're going to go through the income statement, and we're going to label things 1, 2, 3, and 4. Revenue, operating, non-operating, debt, equity. One, 2, 3, or 4. 1. Generally, revenue is operating. A couple exceptions, but generally operating. Operating costs. Well, that's pretty easy. By definition, operating. Depreciation. Let me give you a hint. Where does depreciation come from the balance sheet? What did we call it on the balance sheet? 1, 2, 3, or 4. So therefore, the impact on the income statement should be consistent. It's 1. It's operating. And then we have operating profit, which is the net of the ones above. This is one of the cheats that I will let you do as a shortcut, right? Because generally, before the midterm, we deal with my statements that I give you for assignments. I'm not going to try and fool you and say operating profit has non-operating items in it. So if I call it operating profit, it's going to be operating profit. So if you want to start with operating profit as your 1 to eliminate the 3 counts above, for simplicity, you can actually start your income statement rearranging with operating profit. Let's call that your 1. Okay. Next, interest expense. Operating, non-operating, debt, equity. 3, it corresponds to the interest-bearing debt on the balance sheet, the payment to those debt holders. 3. Equity income. The money we owe SoftBank for the profits we make at WeWork. Theoretically, they may ever make profits. 2, because it was a passive investment on the income statement, a 2, then the payments to those passive shareholders are a 2 as well off the income statement. It's non-operating cash flow. Because it's not going to our shareholders. It's actually going to somebody else's shareholders. Tax. Yep. Yeah, it's actually operating, non-operating, and debt. One of the things we're going to do is we're going to split out the tax effects across the 3 areas. Net income. Who's that go to? Operating, non-operating, debt, equity. Yeah.
Same thing, operating.
Goes to a 4. Net income goes to the shareholders. That's 4. That's equity. Okay? Now, very clearly, the TII ends at net income. Even though dividends are on the sheet, the dividends are technically not on the income statement. They're off the cash flow statement. But to do the CFI, you'll need the dividends. So this is where you stop with your TII. Don't put the dividends on the TII. It'll never balance. Okay? But eventually, we're going to have a cash flow going to the shareholders called dividends. That is a 4. Okay? Now, back to our statement. I'm going to take, yes?
So, in the depreciation, we put it as operating, right?
Correct.
Operating expense. But what if we have, like, a product, like a machinery, which is like not directly like related to a product, but we are like depreciating that asset? Do we like still include that? Because like it's kind of vague.
Well, at the end of the day, and this is why I also don't like solvers for the other reason that I'm about to give you, which is you're not going to like this answer, but you got to use your common sense. You kind of have to look at a category and you have to ask yourself, okay, what is this really helping the company do? Is this something I have to do again and again and again? So, for example, I settle a lawsuit with somebody for a product liability. Is that operating or non-operating? I hope it's non-operating. Like, I hope lawsuits that I have regarding my products are not a normal course of business. So that goes to the point if somebody asked me about what's a non-operating asset or liability. Settling a lawsuit would be an example of that. So what I'm saying is, at some point, you kind of have to step back, and you can't just say, always this or always that. Just say, generally, okay, is this something I use to make my products every day? When I sell more products, is this going to kind of grow with that? That's probably operating. If I'm selling more products and over time this is probably not going to have anything to do with volume, then it's probably non-operating. Okay? So again, that's discretion that we'll have to kind of eventually apply. Okay? All right, so good question. So let's go back. Equals. Start out with the operating part of the income statement to get our no plat. We start out with our ones, and I told you could cheat and start with operating profit if you wanted to. That's our one. And then, since that's our only one, we would say basically what is the tax on the operating profit we would pay? Well, given a 25% tax rate equals that times 0.25, we'd pay $70 million in taxes, which would give us no pat or no plat of the 280 minus the 70. So this is our no pat or no plat, which is the $280 million of profit we made from running the business, and then the 70 of tax that would be associated with that 280 of profit, given the marginal tax rate of 25%. Okay. Next, non-operating profit. Our non-operating profit would be our equity income. Now here's the thing. If we reported $4 million of equity income, we would have a tax on equity income of 25%. So our after-tax equity income would be 3. So our non-operating profit total would be 3. Now, again, David Wessels, one of the authors of your book, friend of mine, is lazy. So he's been doing this for so long. So when he was helping to edit the McKinsey version 6 of the textbook, if you're following along in the book for this example, it's so intuitive to him on the rearranged income statement. 4 became 3. Because what he did is you said equals non-operating investment income times 1 minus tax rate. That's what he did in the spreadsheet. That's the table for the page. All right. I'm kind of writing this out so you actually see how 4 became 3. You made 4 pre-tax. You paid $1 million tax. You have 3 after tax. Now, if you think you're as good as Wessels is, and he's good, that you don't have to do these shortcuts, and you can go straight to the after-tax income equals cash flow times 1 minus tax rate, have at it. But I find, even myself, I like writing it out when I'm starting out because it helps me understand what's going on. So I'm putting some extra categories in here that sometimes they even skipped in the book, just so you actually understand some of the shortcuts that they were taking, because it's so obvious to them that this is what you do. They don't realize it's not obvious to people who have never done this before. But that's how 4 million became 3 million, because you got to put the tax effects in there. So when you add these two together, the TII equals the 210 of the operating income plus the 3 of the non-operating income, 213. 213 of total income available to pay out to my investors. Okay. Yes, sir.
Did you get that non-operating profit number?
Just the 3. It's the only non-operating profit. Now, if there's more than the equity income, I could add those together, but there isn't any. So I just put the category in. I could have, like I said, I could have been lazy. I think I was in the last class, or I just put the 3 in there and I didn't put the non-operating profit. I added it up. But I'm just trying to help you understand operating plus non-operating, so calling those categories to sum up to be TII. Okay? All right. So this now has to equal the debt and equity. This is another part of confusion where you have to forget about FASB and GAAP. The way these statements are structured is not what you're used to under GAAP. The way these statements are structured, I generate profit, I pay out the profit. The two sides had to balance. So if 213 is the correct answer, on the other side of the statement, 213 is the number I have to have. It's not negative 213, it's positive 213. 213 has to equal 213. I have 213 to distribute, I distributed 213. Therefore, distributions on the financing side are positive numbers. I lost money, minus. I had to fund the losses on the financing side. Inflows to the business on the other side of the statement are minus. Okay, so it's not about reconciling cash balances. It's about positive cash flows being able to be distributed, negative cash flows requiring financing. That's the structure of these statements. So I have 213, a positive cash flow, the funds flow, the other side of the statement, the financing side. How did I distribute the 213? The first was to the debt holders. I gave interest expense, I gave $20 million in interest expense. Should that be a positive or negative number given what I just told you? If distributions are positive on the side of the statement and borrowing new money is negative, what would an interest payment be? Positive. So negative 20, it had to be a positive 20. Somebody in the last class said, do I always flip a sign? Not necessarily. Because if the actual statement said positive 20, I wouldn't have to flip the statement. My statement said negative 20, that's why I had to flip the statement to be a positive number. This is what I mean by applying common sense. But it's a distribution, therefore it's a positive number. Okay? That's my only debt payment. However, I would get a tax shield because I could deduct the 20 against my taxes and save 25% of that, or $5 million, so that my after-tax interest expense is 15. So the net payment is 20. I get a 5 refund from the government, and I net paid 15 to my debt holders. By the way, how much tax did I pay when we started? What's the tax the company actually paid? How much tax did the company pay for operating activities? How much tax do they pay for non-operating activities? 1. What's 70 plus 1? 71. How much did they have in tax shield? What's 71 minus 5? There you go. That's how they paid 66 in taxes. Right? So what I'm telling you is we're still going to have the same amount of tax, but now we actually understand how tax is affecting each of the areas. Meaning this is the benefit, the clear benefit of having debt in our capital structure. Right here. So if you want to know the answer to that question, which is what the benefit of the debt, you work for a private equity firm and you're trying to do a model that says, let's look at the tax credits against the cost of capital and see if we can find any, advantage that's not working out in the real world. This is what they do. Right? I can actually model out the impact of the tax shields, and then I can model out the impact on cost of capital. I can see if I can play with that. According to Midline and Miller, you shouldn't be able to do that, but in the real world, it's not as efficient as we really think, and they will actually try and do this all the time. So, long story short, more than we need to know today, but you actually are taking into account the taxes. All right, our final one is our 4s. Do we have any 4s? Yes, we do. We have net income, which is already a positive number. That is the amount available to the shareholders. When we add our 3s and 4s together, TII is the 15 plus the 198. 213 equals 213. So here's the point. I generated 210 million of profit from operating activities, 3 from non-operating activities. I had 213 of total profit to distribute. I gave 15 to the bondholders, and I gave 198 to the shareholders. TII. Clean statement. As I said, I wish the real world accountants would just do this. Make our lives a whole lot easier. Much cleaner about what's happening with the business. But that's just a pipe dream. Questions about the TII? Statement number 3. You're going to breeze through these two. These are not the hard statements. This is the statement that's going to give you trouble. It's called CFI, cash flow. So I'm going to try and help you so you can finish it in an hour, not 5, and go up. But this is the statement that will cause you to give up. Right? I don't want you to give up. So, years, same years, copy and paste. But I mentioned this at the beginning. Cash flow is cash from the income statement minus change in the balance sheet, and you're going to repeat that process 4 times. That's CFI. Cash from income statement minus change in balance sheet is cash flow. Okay, income minus change in balance sheet, cash flow. We're going to do that for the operating cash flows, the non-operating cash flows, the debt, and the equity cash flows. We're going to repeat that process 4 times. Okay, so let's get started. Equals cash from the income statement, TII. That was the operating cash, no plat. Now, the actual cash is our no plat plus depreciation. Because built into that no plat was $20 million in non-cash expense. Because we have to subtract the non-cash expense to pay the taxes. But since it's non-cash expense, we add it back to get our cash flow. So that is going to be something called gross cash flow. So no plat plus depreciation is gross cash flow. Our depreciation is $20 million. This is actually a sign that we will flip because we're adding it back. 230 of gross cash flow. That's the cash coming from the income statement. Minus reinvestment in the balance sheet or change in the balance sheet. The reinvestment in the balance sheet, for our purposes today, I'm going to keep it simple, is the change in operating invested capital equals current year operating invested capital minus previous year operating invested capital. 60 plus depreciation. 20 equals gross investment. Now you might say, where'd the 20 come from? Okay. Put some formulas over here on the 4th sheet. All right. So if you think about what's actually happening here, operating invested capital is basically working capital plus PP&E. But from a cash flow standpoint, PP&E is actually gross investment is change in working capital, but instead of PP&E, it's called CapEx. CapEx says if we take our starting PP&E plus CapEx minus depreciation, we get our ending PP&E. Rearranging, CapEx is ending PP&E minus starting PP&E plus depreciation. So if I take my clean change in working capital, and if I take my CapEx, which is ending PP&E and starting PP&E, this together is change in invested capital. What's left is plus depreciation. So because we're actually using CapEx and not just a pure change in PP&E, the extra part between the two is the net PP&E. So that's why we have to add it back here. Right? So basically, 80 is what's being gross invested. And that gets us something called free cash flow. Equals the 230 minus the 80. That is our operating free cash flow.
I get the 60.
60 is the change in the operating invested capital, which is the change in the working capital and the PP&E. 440 minus the 380. So we spent 60 on operating invested capital, and then there's an additional 20 that was added to CapEx. Because think of it this way. If we had 380 and we spent CapEx of 80, we would have 460, and then if we had 20 depreciation, we get to 440. So our CapEx had to be 80, okay? And that's what we represented here. We had to have spent 80, okay? So essentially, I'm shortcutting this for simplicity. Later, we're going to forecast out working capital and CapEx more specifically, and it'll get a little more clear. I was trying to keep it very simple for today, but nonetheless, that's how it's going to work. All right? Now, continuing on. Non-operating cash flow. Any twos from the income statement. Look at our TII. That was my after-tax equity investment, $3 million. Then, change in the non-operating assets and liabilities equals change in, and I'll do it in each of the two directly. So is my change in equity investments. Keep it simple. Change in equity investments. So here's the thing. My equity investments went from 15 to 25, so they went up by 10. So here's the thing. I'm trying to get my CFI. So here's the point of CFI. CFI is the cash that I have generated from operating and non-operating that I'm eventually going to be able to pay out. If I make 150 from running the business, does that add to my CFI? Does that add to the cash that I can pay out? Yes, it does. If I make $3 million of profit from non-operating activities, does that add to the cash that I can pay out? Yes, it does. If I increase my equity investment in WeWork by $10 million, does that add to the cash that I can pay out? No, it does not. So I have to subtract that 10. So either to recognize and subtract the 10 or flip the sign, you can choose. But the point is, it's negative 10 to my cash flow when I increase my my equity investment. So therefore, free cash flow, actually, I'll write it out. Non-operating cash flow is negative 7. So my CFI is the 150 from operating activities plus the negative 7 from non-operating activities, 143. So the way I got to 143 is I made 150 running my business, 3 from putting money in other people's business, and I increased the money I put in other people's business by 10. I generated 143 of cash to be distributed. Everybody with me? So far, easy? Okay. All right. Now for the hard part, getting the CFI to balance. There involves 2 tricks on this side of the statement. And if you don't follow the 2 tricks, which are explained in the book, you'll never get the statement to balance. So let me give you trick number 1 and 2. Starting with the debt equals debt payments off the income statement, which is the interest expense, after-tax interest expense. We paid out 15, and then change in debt. Our debt went from 225 to 200. So does that mean we paid off debt or did we increase debt? We paid off 25 of debt. On this statement, if I generate cash, I distribute cash. So when I pay off something, it's a positive number. So since we paid off the debt, positive 25. I gave, and you'll just get used to this, of the 143, I gave 15 in the form of interest to my debt holders, and I paid off 25 in principal because I had 143 to pay out, and I used 25 of it to pay off the principal. 15 interest, 25 principal. Trick number 1. Now I get to my shareholders. Payments to the shareholders. Is net income the amount of money that I actually distributed to my shareholder? What's the amount of money that I actually delivered to my shareholder called for the income statement? Dividend. Trick number 1. When you do TII, which stops in net income, you use net income to balance your TII. But when you get to your CFI, cash flow, net income isn't necessarily the amount of money you distributed in cash to your shareholders, so we flop net income for dividends. Trick number 1. So on the CFI, our dividends, the actual cash paid, was 103. And that's a positive number because it's actually a payment to the shareholders. And then we have our change in equity. Now, the only 4 that we have is retained earnings. So my retained earnings went up, equals 265 minus 170. So it went up by 95, but since I increased it, that's actually bringing new equity to the firm. So I got to flip the sign. So now when I sum these, I should get 143. Balancing statements are critical, otherwise I made an error. What mistake did I make? Yes.
If this is the cash flow statement, then you're not supposed to use retained earnings.
Give the guy a prize. That's the second trick. And that insight is critical, otherwise you're going to just give up on the statement. Because there is no amount of changing of these numbers, playing around with the signs, that's going to get the statement. Because, if you didn't hear what he said, change in a non-cash item shouldn't be on the cash flow statement. Retained earnings is a non-cash item. And so therefore, a change in retained earnings has no impact on cash. So I said there were 2 tricks to the CFI. He identified one of them. So the first trick to the CFI is dividends, not net income. The second trick, never retained earnings. Non-cash accounts, change in non-cash accounts do not go on the CFI. Retained earnings is a non-cash account, just an arbitrary plug. So therefore, it actually is not a cash flow. And if you put a change in a non-cash account onto that CFI, you're just going to get really, really frustrated. So those are the 2 tricks. And when you do, notice you now have a balancing CFI. You'll also only have one CFI for 2 years because in order to get a CFI, it's a change in a balance sheet. So 2 years of statements, 1 CFI. 3 years of statements, 2 CFIs. 5 years of statements, 4 CFIs. 5 years of statements, 5 TIIs, 5 TFIs, 4 CFIs. Okay? All right, final statement. It's called economic profit. EP for short. Statement number 4. To get economic profit, again, carry over the years. Prior, current, and label, which will probably be actual years when you get your assignment. All right, so to get economic profit, we take our NOPLAT and we divide it by our operating invested capital, And that gets us something called ROIC. But we're going to use something called BOY ROIC. And BOY for this assignment means beginning of year, as opposed to EOY, which is end of year, versus average, which is beginning plus n divided by 2. Right? So for this assignment, you're going to do BOY ROIC. What does that mean? You take the current NOPLAT and you divide by last year's or the beginning of the year's invested capital, 55%. I'm going to give you a whack as part of your assignment. Let's say I gave you a whack that was 10%. Then you are going to calculate a spread, which is the beginning of your ROIC minus the whack. That is how much more than the opportunity cost that you made. Economic profit is spread times beginning of year invested capital. So if I started with 380 of capital and I made an excess 45.263% on it, then I generated 172 million of value during the period. That's called economic profit. It's also called economic value added, or EVA, but since Stern Stewart owns the trademark, the rest of the world calls it economic profit. This is EVA. But we balance it. Method number 2. If I take my dollars of NOPLATs and I subtract a capital charge, which is the invested capital times the WACC. Matter of fact, it's going to be the beginning of year invested capital times the WACC. So my NOPLAT is 210. My invested capital is 380. I needed to make 10% on 380. I needed to make 38. How much did I actually generate in value? Made 210. Needed to make 38. I did 172 better than what I needed to make. Method number 2. Balancing EP. These are the 4 statements that you have to create. These start with TFI or TII. These are the balancing. This is what's going to be checked. Do your TFIs balance? Do you have the right operating invested capital? Do your TIIs balance? Do you have the right NOPLAT? Do your CFIs balance? Do you have the right free cash flow? Do your economic profits balance? Do you have the right beginning of your ROIC? That's how you're going to be graded. Even if you have the right ROIC, even if you have the right free cash flow, if you don't have balancing statements, you're not getting credit for the statements. So again, when your statements don't balance, and the one that's probably going to give you the most trouble, CFI, remember 4 things. Number 1, the labeling is your friend. Count the ones. Make sure you have the same amount of ones across the statements. Don't lose any. 2s, 3s, 4s. Labeling helps you. Keep them together. Number 2, recognize the difference in the format from GAAP FASB, which is basically TII, CFI, basically one side of the statement, cash generated, the other side of the statement, financing. The 2 will always equal. Therefore, on TII and CFI, positive cash flow, positive payouts, positive numbers on the funds flow. Negative cash flows, have to borrow, negative inflows on the funds flow. Tricks on the CFI, dividends, not net income. And the final trick, don't do change in retained earnings because that's a change in the cash account.